Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is July 20th, 2011, and my guest is Anat Admati, the George G.C. Parker Professor of Finance and Economics at the Graduate School of Business at Stanford University. Anat, welcome to EconTalk.
Thank you.
Our topic today is financial reform, and in particular, some proposals that you have made and ideas you have about making the banking system more stable and focusing on capital requirements. So talk about the idea of equity in the balance sheet of a firm and what a healthy proposal would require compared to what is going on today.
Yeah, I think the first thing to really talk about when you talk about capital requirement is what does it mean capital, because they use this word very differently in banking than anywhere else. And so people get very confused about this. You start having the journalists explain to you that, you first of all, everybody says you hold capital. That's already a big peeve that I have about the word hold, because what we're talking about is the following. It's critical to think of balance sheets when you think about this. So everybody has a balance sheet, governments has balance sheet, all banks, all companies have balance sheets. And a balance sheet basically has two sides, or it's stacked together, one on top of another. And basically, one part of it that balances with the other is what you own, what you have, what are your assets. And then against that are basically, so the liability and equity. So these are things that you kind of owe versus the things that you own. These are kind of claims against the assets. So
Okay.
These are promises you made to pay out of the assets that sort of call upon the assets to pay, or the remainder, which is equity. So equity is basically the asset minus liabilities, is what we're talking about. So for every bank, if it's for the banks, all the stuff that they own, which is all the loans that they made, everything that pays them, and then on the liability side has all this stuff that they owe, so the demand deposits that people can come and ask for, all the money markets, all this stuff, and all the bonds that they issued, various kinds of bonds, short-term repos, thousands of kinds of commitments that they made to pay.
We're going to call that debt.
And that is the debt. And then the difference between them, which is usually a very small sliver in the case of banks, is the equity. They call this capital, and they talk about how much capital banks are supposed to hold. But actually, that capital, it's not the banks that hold it. That equity is held by some investors somewhere.
Correct.
So the holding, when they say banks hold capital, or set aside capital, or hold on reserve capital, or all of that, that's completely misleading.
So it conjures up an image of stuff sitting around doing nothing, which is not the case. But let's go back to the balance sheet and go very, very slowly. So I'm going to start a bank, and which is going to be problematic because I have no reputation. But let's suppose I have a reputation, and I start a bank. So I take in through my doors cash that people want to deposit. So what side of the balance sheet?
That's the debt. That's part of your debt. It's called demand deposits. It's demandable debt.
Because they can come back and get it.
They can come back anytime, and that's part of what banks do, is they sort of provide that. They issue these kinds of debt instruments that only banks do, usually. Deposits.
So normally when I think of capital as an economist, handicapped as I am by the fact that the only accounting I know is from a friend who I helped her pass her accounting class.
I don't know any. That's usually bad for finances to know accounting.
Okay, but help me out here. So one source of funds for me as a bank are my deposits, which create a liability because I have to pay them back.
That's right.
The other way that I can attract resources that I can do stuff with is investors.
That's right.
People who buy the stock of my bank.
Precisely.
And that's
they own
a
residual.
share.
They own the residual just like the equity of all the other companies in the economy.
So they have a claim on the cash flow of the profits if they
debt
come
is paid.
after
Or dividends,
and expenses
or earnings,
and other things are paid. Now, if, for example, half of my assets are demand deposits and let's say that's $500,000, and $500,000 I raise, would be the verb, in equity among my trusted, greedy, return-hungry friends, then I would have a 50-50 equity debt mix. Is that right? Have I said that correctly?
Right. That's right.
So when you say, let's now go to the let's go to the other way, or maybe the same way that capital is used in regulatory discussions. Mm-hmm. In the current environment, which is ruled by Basel 2.5 or whatever we're at,
somewhere in there,
banks have capital.
Actually, the U.S. never adopted Basel II.
Really?
Yeah, it was overwhelmed by the crisis, so they never quite got around.
Oh, we never got to 2. Oh, sorry.
Never got to 2. Yeah. Now we're talking about 3.
Yeah.
Now EU just adopted 3.
So if
yes. Say Basel II.
So Basel II has
principle.
Yeah, Basel II has capital requirements.
Yes.
So what does that mean? Let me say it a different way. If I'm a bank and I have to keep, quote, 10% as a capital requirement, what does that mean?
So the way they do it is they want to adjust it to the risk of the assets. So they have this system that they created, and it's called, they sort of measure how much equity you have, not relative to your total assets in value, but relative to what they call risk-weighted assets.
Right. Is this tier 1 and tier 2, or is that something different?
The tier 1 is sort of how much you have, but when you talk about tier 1 as a ratio, what's the denominator? The denominator usually, in all the requirements so far, in Basel III, they're going to introduce some leverage ratio, which
we'll
is
leave
going
that
to be
alone for now.
But the requirements, with the numbers they're talking about, the 4.5 to 7, and the 7%, and the extra SIFI charge, and all of that, that is equity measured in some way. There's also issues about how you measure that: market value, book value, fair value accounting, marking to market. So how do you put a number on that? But the denominator of that is always risk-weighted assets. And so the big issue is, how do you figure out what their risk-weighted assets is? How do you give weights?
That. I'm asking a simpler question. Let's ignore the risk-weighted question for now. If I'm a bank and I have to have 10%, quote, capital, what does that mean?
Well, what it means is that they would look at your balance sheet in some periodic way, and they would make sure that you have that. And what it means is that if you somehow go below that, then they'll start intervening or something like that. So
I have to comply with that requirement.
You have to comply with it. Now the innovation of Basel III, which really is an important innovation in principle, is that there's a sort of a conservation buffer. So the idea of having what we saw in the crisis, among other things, is the requirements themselves can create a certain dynamic by just having to comply to them. So if you always have to the buffer cannot be a buffer because you can never run it down. So if it's supposed to be a cushion, that is, suppose I have 20% equity in a house. Okay, so I bought $1 million house with $200,000.
Down
payment.
Down is equity. That's equity. Right, that's the same idea.
That's equity. Versus, being subprime loan or being a highly leveraged bank, you put $20,000 and buy $1 million house.
Correct.
That's 2% equity. And then the house value fluctuates, like these assets, like these mortgage-backed securities, like all of these things. As it fluctuates, then I become, if it goes down, I become sort of distressed. I
Insolvent.
become insolvent. I can go underwater because my assets will be worth less than my liabilities. I'll have negative equity. In that case, if I need to comply to capital requirements, I could try to kind of salvage it by selling part of the house. This was sort of the fire sales that we saw, the dynamics of that, where we're sort of deleveraging. In order to deleverage, in order to maintain 1% of the assets as the assets go down, you need to sell the assets quickly. And if the assets are illiquid, that creates a whole dynamics of selling and fire sales.
Or if everyone has the same kind of
the same assets, precisely. And so everybody's trying to sell the same things at the same time. And partly it's to comply with the requirement, partly. And of course, it creates this sort of deleveraging cycle, kind of vicious cycle that we kind of saw play out among other things that we saw in the crisis. So the idea of a conservation buffer is that, the story that, my friend Charles Goodhart, who's a banking expert in UK, likes to tell is sort of about the taxi cab in the station. So you have a requirement to always have a taxi cab at the station. And when you get there at 3 a.m, the taxi cab that's in the station cannot take you anywhere, because then there won't be a taxi at the station anymore once he took you.
Right, yes, yeah.
So you see the problem here. So basically the idea of the buffer is that you have say a 7% kind of at normal time, but you can draw down on that down to 4.5%. And what happens within that buffer is you can't pay dividends. You have to conserve the capital when you're in that window, because you're not in a healthy situation. You need to try to strive to get back to the 7%.
So let's put the buffer to the side, though, and I want to get to your arguments.
Yes.
But just to clarify this issue and to get some vocabulary, if I'm holding 10% of my assets in the form of equity and 90% in the form of debt, we say I have a 9-to-1 leverage ratio, right?
It depends how you define a leverage ratio. Oftentimes when they say debt over total, they call that leverage ratio now in Basel. So that would be like 10% leverage ratio. But
I mean equity over.
Equity over total assets. So the 3% that they're talking about in Basel, 3%, by the way, 3 is equity over total assets.
So that's a 97-to-3 ratio, which is...
They don't usually do it.
I know, but I'm doing it that way because it makes more sense, a little more sense to me.
Debt to equity. You're saying
correct.
Debt to equity. People measure leverage like that. There are various ways to measure it. It's D over E, D over D plus E, whatever.
But when my equity is 3%...
Yep.
Let's go back to the house.
That's 30,000 over $1 million to $1 million.
30,000 over $1 million. The house, let's say, loses 5% of its value.
You're underwater.
It's now worth $9,950,000.
Yeah, yep.
And I only have 30,000
in equity.
Which means that if I had, here's the part that's I think confusing for some listeners. If I had to sell the house today at its current value, which is 10% less than I paid for it, I would not be able to meet the loan that the bank had. I could not pay off my loan.
So if it's a non-recourse loan, you can actually walk away from the house.
I understand.
Now, sometimes you would stay.
I might for all kinds of reasons.
Because you have an option that the house might go up. So it's underwater, like and out of the option, and out of the money put option, you still want to maybe wait for the upside. So you still might want to pay the mortgage over time in the hope that it would go
up. Or
up.
it's a pain to move. I don't really want to sell because there's transaction costs. There's a lot of reasons.
But you might choose strategically to walk away.
And if it fell enough, if it fell 50%, I might say, why do I continue to invest in this asset?
So that's a strategic default. It would ruin your credit rating, but
I might not have one anyway.
Exactly, but it might make sense to foreclose, except if they had the documents, which is a problem.
Yeah, another problem. But that's a house. Now, if I'm a financial institution, a bank of some kind, I have assets of $1 million that I finance 10% with equity. That is investors.
This is in a great situation, yeah.
That'd be 10%. I have $100,000 in investors that I've raised, and I've borrowed the other $900,000. The asset goes down. Let's say it goes down. It goes down by 15%, more than the equity. In that story, as we said just now with the house, it's true. I'm quote underwater, but I haven't sold the asset. I don't have to sell the asset. The problem becomes that the lenders, might get uneasy because their recourse is that collateral, which is now worth less than their claims on it. So they might say, I think I've had enough. It's time for me to get my money out, and I wouldn't have enough, of course, to pay them off.
Then
the government
will come.
What?
The government might come to help you.
Correct, which is a bailout. Right. Well, the government won't come. It's a bailout.
It's a liquidity support. It's whatever they call it. Windows will get opened up.
Well, they wouldn't come to help me, the bank. They come to help you, the lender, which is.
They want you to be able to pay. So either FDIC, would kick in if you're really going to become taken over. Then the deposits will be taken care of by the insurance.
And if I'm an investment bank like Bear Stearns, it might be that the government simply creates a marriage between J.P. Morgan Chase and Bear Stearns using the justification of and guarantees the bad assets because they want the creditors
to be happy.
Or to create financial stability. We're not going to debate what the real motivation is. Yeah, there's a lot of possibilities there.
Right.
So my question is, why, because we're going to get to your proposal in a sec.
Yes.
As a institution, as an investment bank, as an executive in such an institution, I like leverage. Why? Why do I like leverage? Explain to us why, because leverage, again, as you've pointed out very, very well, there's a lot of different ways to define it, but it's clear that, say, between 1980 and 2007, there was a big change.
Huge.
In 1980, investment banks were, quote, using their own money. They were partnerships. What are the advantages to being able to borrow lots of money, and why do you think it happened that it changed so dramatically over the last 20, 30 years?
Well,
start with the advantages.
The advantages of debt are, there might be reasons here that we're not completely understanding, because actually when I talk to bankers, there seem to be like just ways they think about it that kind of don't quite make sense to me. But from what I see is rational, at least, on their perspective, are mostly the subsidies associated with debt. So debt funding for banks is subsidized through the tax code, which subsidizes everybody's debt because of interest tax deductibility.
Debt on housing purchase.
On everybody.
Well, not everything, because I can't deduct. Corporate debt. Yeah.
I'm talking about corporations.
Yeah.
So corporate debt, interest payment on corporate debt are tax deductible. That immediately is the first friction that we talk about in terms of how do you want to fund. There's a tax advantage to debt funding over equity funding. So it's just like right off the bat, when it comes to funding, to the economic funding, this way of funding is subsidized. The debt, in other words, promising,
in this case, through the tax code.
You pay the total available to everybody becomes larger, which of course, since the equity takes off the top, the equity benefits, the debt holders come at the appropriate, zero net present value to them, so they just get promised what the value of their claims are, and equity reaps the tax, shield the tax advantage of debt. So the more leverage, the more tax benefit comes into that whole balance sheet.
But corporations generally are not as leveraged as banks.
That's right. So now you have to ask yourself, what's the difference between a bank and other companies when it comes to the economics of funding? Now, that was basically where I came from, because I was never in banking. I know and teach corporate finance. So what's so different about banks? Why should banks have such a different capital structure than the rest of the world? Nobody has anywhere near this kind of leverage, and nobody almost can have this leverage. And that's part of the point.
Yeah.
Everything is different. In the rest of the world, we talk about trade-offs. We talk about trade-offs between debt and equity. Yeah, there's a tax advantage to that, but there is these bankruptcy costs. Well, who's going to pay the bankruptcy costs? And bankruptcy costs are not the risk of bankruptcy, because if you can dissolve immediately, there's no cost. It's just a change of ownership. But the sort of deadweight cost, the fact that it would deplete, that lawyers will come in, that it would deplete, and especially something that other companies are very aware of, there are all kinds of distortions in investment decisions that get made when equity makes a decision in a highly leveraged firm. So they start having incentives to take more risk. They start having what's called debt overhang, so they can't take advantage of good projects because nobody wants to come in when they have so much debt commitments. So
that's a natural set of forces that restricts.
And what happens as a result of that, as a result, for example, of companies that have leverage having incentives to gamble with the debt holders' money, it's like up we win, down you lose.
Yes.
Is that they put covenants in, they put restrictions, and so any debt instrument starts coming with a lot of baggage.
Strings,
of you can't do this and you can't do this and you can't pay dividend, you can't invest in this and you can't merge. You got to go back to the debt holders because they're obviously anxious about you making decisions with their money.
Because as we have said many times on this program, equity holders benefit with the upside.
Right.
They get wiped out, but the upside they get a big return. Debt gets a fixed return, so the only thing they worry about is avoiding the destruction of the company or anything that won't allow them to reclaim their principal.
That's right.
And as a result, debtors are the watchdogs of prudence.
That's right.
In a normal system.
Right.
It's not the system we have.
Not in banks. In banks, somehow, because so much of the debt of banks comes under an ever-increasing safety net, the discipline doesn't work.
The what doesn't work?
The discipline of
correct.
debt does not work
Right.
for them at all. There are many ways in which you can even understand why. First of all, there's a certain way in which once you're so highly leveraged, it's almost addictive. Like you're in permanent debt overhang. You always want to fund with more debt, and you always have these incentives to take risks, but you can't get out of there by yourself. It's almost an addiction that somebody needs to yank them out of that place where they are with 5% equity or however much, into a much healthier place in the spectrum. And that would be a space that we used to have,
yes,
way
correct.
back. Not
so way back, but 30 years ago.
Or 50 or 100. It's not the good old days necessarily of everything, but it's the good old days of equity.
Yeah, with you
where you actually had to worry about things going 25%, below, and it was your loss as equity and managers to bear.
So let's talk about the safety net.
Yes.
Some of which we've talked a lot about in this program, but let's review it, and I think you have some additional things to add. Why is it, so normally, in a normal corporate American corporation, as the proportion of my assets that are financed by or debt rather than equity, that starts to introduce a great deal of anxiety in the form of other debt holders. There's a certain natural restraint.
Agency problems, yeah.
Right. Why is that? What is going on in the bank world that has made that restraint loosened or non-existent?
Well, first of all, you have deposits.
You have what? Deposits.
The deposits are insured with FDIC insurance. So that already takes care of a big chunk of the bank's debt that doesn't worry about anything because
right.
And so, when you even have models in banking that say the depositors are going to threaten to run or something,
right.
That's not a credible threat because they're insured to $250,000 now. And in fact, you
can get around that too.
Okay, exactly. You get around that because you have deposit brokers and they place you as much money as you want under deposit insurance these days. And so the FDIC is there for a large chunk of and it's not just that. If you want to play that yield game and go and have, money market funds that also supposedly have, buck guarantees and, go out there and explore, the minute something seems wrong, there you are back in the deposit insurance world. So all of a sudden the balance sheets of the banks with deposits swelled in the crisis because everybody wanted the safety of the insured deposit. So that's kind of an option you always have, is to come back to the system
as a depositor, an investor, yeah,
because you can move the money back into the safety net
very quickly,
and all of a sudden, voila, you're insured.
Yeah,
and you can go to multiple banks or whatever. So the system is there to kind of make sure that you don't never lose as a depositor.
That's true for Bank of America. Mm-hmm. It's true for Citibank
right.
on their banking side. Let's talk about investment banks.
Okay, so what happens now with investment banks is that
to the extent they exist.
Well, they don't exist. They're all together. So it's universal banks that we have now. So everybody's a bank, banking holding company, Goldman is a bank. Everybody likes to have the access that banks have to the Fed discount window, to all these liquidity supports that will always be there or supposedly be there. And so what effectively happened in the crisis, actually, possibly one of the worst things that happened in this crisis, is that the exact opposite of what was supposed to be the lesson of Lehman, exactly the opposite was learned. The lesson was supposed to be that here we are, we're going to let you fail, and we're not going to do what we did with Bear Stearns. Instead, they let them fail. Within 12 hours, it became clear it was a big mistake, probably, or who knows. But in any case, the conclusion was that they shouldn't have let them fail, because look what happened. And so the second guessing of that is, of course, large. But the bottom line of that is everybody became a bank. And for the largest one, it is sort of received wisdom in the market, including credit agencies and everything, no matter what Dodd-Frank says, that they will not be allowed to fail. They cannot be allowed to fail because that would create all these problems. And look at Europe right now.
And just to again review from past episodes, the Bear Stearns, and I want to come back to Bear Stearns and Lehman, that nexus, but the Bear Stearns rescue in March of 2008. Was a rescue of the creditors of Bear Stearns. The equity holders of Bear Stearns got wiped out. And so what this continually does, first of all, allows the government to say, oh, we didn't bail everybody out. Bear Stearns creditors lost everything, right? But what it continues to do is subsidize leverage. It continues to say to the market...
Because the leverage doesn't charge the right price.
Because it's safe.
Usually there'll be a risk premium or at least an asked extra yield because of the risk.
So let me ask a question about the weird world of investment bank lending and debt that is a little bit different than the world that you and I live in.
Yes.
A lot of their borrowing was extremely short term.
Yes.
That is
overnight,
one day.
Hours, yes.
Overnight. So what Bear Stearns and everybody else, to different amounts, but similarly, what Bear Stearns was doing was borrowing a lot of money overnight using what turned out to be not so hot collateral, which were their mortgage-backed securities. What was going on there? Why did it take that form rather than a more... What was the advantage to that world of that kind of... Because I don't understand that. It's a piece missing from my story.
Well, the short-term debt has sort of a liquidity to it, a demandability to it almost. So people like it. They like to just place their money overnight and play with it. They just don't like to let it sit even hours. And so it's supposed to be this self-perpetuating kind of way. There's this renewable debt over short. What basically happens with short-term debt is I think that you always have, we have even models of that, we always have incentives it's a sort of maturity rat race that you get. So you always have, by making debt shorter and collateralized, you always have, it is essentially a conflict of interest where when you have debt, equity always wants to issue debt that's equally senior or more senior than existing debt, because that actually takes advantage of the prior debt that's already there. They can't do anything about it. It's very similar to taking risk on their back that they didn't. So it basically, when you have some debt in place, you always have incentives to kind of take on a little bit more debt, sort of shorter maturity.
Why? I don't understand.
Because you can get that, because those debt holders will not demand, they feel very secure. So they don't demand a lot of interest.
Because it's shorter term.
Because they're very senior at that point.
Oh, you mean in case of a crisis, they're going to get it?
They're first, because they can pull the money out first. Because their claims are payable within, their...
Sooner? That matters?
Sooner, yes. Sooner is more senior, basically.
Okay.
So basically, what it creates a situation where you have an enormous maturity mismatch in the sense that the assets themselves are very long-lived assets, and liabilities are extremely short-term. The short-term funding is very, very fragile because at the minute that these funders have any suspicion that there's going to be a problem right in that little window, they are out.
But that's the puzzle, because if you're right, and I think tell the same story, and this has bothered me for a long time, if we're right that the safety net encourages debt rather than equity...
Well, there's no other way about it. It must.
But then why would I be so worried as to only offer overnight funding? Why wouldn't... In other words, what are the advantages?
I think it supports all form of debt. It just, there's sort of this demand in the market, just like there's a demand for deposits for this short-term debt. They'll do any debt that people want, but as long as it's debt, the key is that it's debt, because this debt, once you're promising to pay and you're under a safety net, your funding cost is cheaper.
Right. So you're suggesting.
So I'm saying debt of any kind is good.
But why did it overwhelmingly take this form?
Because that was sort of the way, commercial asset-backed securities and the way money market funds, wanted to work.
But the puzzle is why? Because you'd think, well, you wouldn't need to do it overnight because there's so much. Why should I work? If the biggest advantage of, remember, we're not talking about 6 weeks. We're talking about 6 weeks versus 6 years. We're saying overnight. So if I'm not worried because I'm going to get my money back because the government's going to bail me out, why am I willing to own? Why is it that the market produced this world where so much of the borrowing and lending took place overnight?
Well, I think people want to have access to their funds. There's sort of all these liquidity needs, and so you have payment systems and businesses that just like that liquidity. They like to work in that way. They wouldn't buy sort of long-term bonds.
Not to tie up. Yeah.
They don't. So they like. There's a lot of money that wants to be parked for very short amounts of time.
It gives you a nimbleness, a flexibility.
As long as, and so that kind of works until it doesn't. So the point about it is that it is a very fragile funding system, and that's the problem. And so what we're saying is that if people really like that because they have utility out of that liquidity, such as we like deposits and we like to know the money's there and we can get it out, then that's fine. But they can back it up. In other words, do whatever is your business to do at the right economic price. In other words, once you own the downside of that and you're not relying on safety nets, then fine.
Okay, so let's go back to your suggestions for the future. So first, just to summarize where we are now, basically we're saying, and there's nothing controversial about this at all, that when so much of your balance sheet is debt rather than equity, small changes in assets, which were impossible because they're so safe, but turned out not to be so safe, small changes created insolvency or impending bankruptcy.
Just stress and therefore kind of refinancing problems.
And as a result,
you get credit freezes,
we got the problems that we had. And now to prevent that, I would argue that we should get rid of the safety net.
Okay.
Now, so you're going to take a different approach. You're going to say we're stuck with the safety net to some extent.
I'm going to reduce it.
Okay, tell me what should we do to reduce the probability of the next crisis?
The way, in my mind, the most cost-effective, the most obvious, the simplest, most direct way to address not just one problem but multiple problems that this system suffers from is it would reduce the safety net, it would improve the kind of types of decisions that are made, it would shift the risk where it should go, all of those things.
Take out the distortions.
A lot of distortions all at once, and sort of say, just align everything better, is to dramatically restructure that sort of side of the balance sheet, the funding side. In other words, there are proposals, the Volcker rules and ring fencing and breaking, what Honig is saying and all that. That is on the asset side. Break them, split them, this way and that way. Make them
smaller so that in theory, we could then let them fail.
Right, but then there'd be, if you have a lot of small ones and they're highly leveraged, they still be interconnected and they can still domino effect fail.
What are you going to do? How are you going to measure it? How are you going to
the key first, the key thing first is to structure. So effectively, the change that we're proposing is a very simple change to the system, which is essentially reshuffle the claims in the economy. Everything is still held by the same end investors. But what we're doing is there's a lot of sort of risk capital and equity capital that's out there. And there are all kinds of debt commitments in this market. So if you think of the big picture, what we're saying is there's too much debt-like stuff and too little equity-like, claims in this financial system.
Sure.
We need to make that system owned and funded by a lot more equity. There's much capacity if people need to for all kinds of debt, to be issued by lots of incredibly well-capitalized, entities out there. Apple can effectively issue treasuries. They are so safe. They have 100% equity funding in Apple. Bob Hall likes to say they have 150% equity funding because they also own some debt. People owe them, so they cannot fail because they hardly owe anything, in a financial claims sense. Lots and lots of companies. I mean, the average company publicly held is 70% equity in this economy. Here we have 95% debt, 5% equity or something.
So the idea would be that if the safety net weren't there, if we didn't subsidize debt, firms would naturally, through the marketplace and their own self-interest, be forced to be much less leveraged in the financial sector.
Maybe not 70%, but it's a financial sector. Look
20.
At REITs. Look at real estate investment trusts. They have about 30% equity. They don't have a safety net. That's just a benchmark.
Yeah, no, that's a nice point. So the argument would be we should have higher equity requirements for banks. Mm-hmm. Now, isn't that what we've had all along?
What do you mean all along?
The whole Basel I.
The numbers are tiny.
Okay, so you're suggesting a
whole different order of magnitude. I mean, they don't barely get to 2 digits, and even that's based on risk-weighted assets. I'm talking about even sort of adjusting for risk in some fashion. So obviously, balance sheets have to be somewhat monitored for risk taking on the asset side. But, sort of based on where we are today, I don't begin to see the social cost of having, 20, 30%, or a range that's between 20 and 40%. Gene Fama said, 40, 50% sound good to him, no problem, what's the problem?
Well, we know the problem, of course, is political. So let's
yeah, of course.
But you mean economically, financially?
No, that's what he meant. He meant that seems like a healthy system to me. People own their decision, let them go.
So let's talk about some of the criticism. So there's two issues. Of course, there's political and economic. Right. The political issue being, which of course are going to get tied together, political issue being that, strangely enough, the banks don't like that kind of idea. And in fact, in the current world we're in, where Dodd-Frank is sort of enforced, it's not fully fleshed out, there's already been, I've seen stories that Barclays changed the way they define something because, quote, they didn't like all that capital sitting around.
Yeah.
Now
trapped.
Somebody said tied up,
it's like
whatever.
Imagine a little cage and capital.
There are all these metaphors, but I don't understand. And we'll put it up on the web. There's a really nice slideshow presentation that Anat put together called "Some Medicine for Crisis Prevention."
I have other slides.
And there's
we
others.
Can discuss which ones you want.
And you have,
since then.
And there's technical papers, Why Bank Equity is Not Expensive, a paper with DeMarzo, Howig, and Fleiderer. But we'll put those up. We'll put links to those. But let's talk about this tying up, not working idea. And let's put it in the context of Bear Stearns and Lehman. So my claim, and some people agree with this, not everybody, is that it's not the failure to rescue Lehman Brothers creditors that was the problem. It was the decision to rescue Bear Stearns. That when the government did that, when the Fed did that, and it orchestrated the marriage of Bear Stearns and J.P. Morgan Chase by guaranteeing the toxic assets of Bear Stearns, they set a signal to the market, which was a very powerful signal that said, if this happens, don't worry. Now, I've tried to look at, with modest success, not much meaning, what happened to Lehman Brothers between March and September of 2008. Because the standard, if Bear Stearns had been allowed to go into bankruptcy, if all its creditors had been wiped out, or had to take a serious haircut, my presumption is that Lehman would have had to continue its operations in a different manner. In particular, when Lehman failed, Reserve Primary, a money market fund, broke the buck, which means they did not have enough assets to cover their promises, at least
if they promised $1.
Right, which is a little bizarre, because why would a money market fund be lending money to a firm that is as risky as Lehman? The answer was obvious, because they were getting a good yield. But normally you would say, but the yield's not worth it. But they thought, well, hey, we're probably going to get rescued. So my question is, this is a practical question. What could Lehman have done in those months if the government had come in? This is not the world we lived in, but if the government had come in and said, we made a mistake. We shouldn't have rescued Bear Stearns, and we're going to impose unilateral, without legislative authority, a higher capital requirement on you because you look like Bear Stearns. Your balance sheet is way too leveraged, your assets are way too risky, and I want you to change your equity debt ratio. What actions could they have taken?
The one critical thing that they should have done, and this was true for all the banks, and we know that now, that is so in our face, it's crazy. From 2007 on, they should have stopped paying those dividends. That was criminal that they were allowed to pay so much dividends. Through the crisis, banks were allowed to pay dividends in this country until 2009.
So what that meant was, even though they were
depleted their equity, right there.
And dividends are payments to equity holders.
So that reduces the amount of equity that's there. If you retain your earnings, that's equity. It's money that belongs to the equity that backs up the debt, which is exactly what they don't want to do.
So they had...
Any dollar in dividends is a dollar that can't back up the debt.
Okay, so that's one thing they could have done.
Immediately retain dividends. The easiest way to raise capital is internally.
How much would that have?
I haven't looked at those numbers. Really, there are papers that actually looked at the dividend payments, over the decade before, and it's even, 2007 and more. And I wrote a number of pieces on the dividends because this was really one of the worst things that happened this year was that the banks were allowed to pay dividends.
But the standard phrase that is used in this situation, which I think is related to your ideas, they needed to, quote, raise more capital. Yes. What's the logistics? What does that mean? Issue stock? How would they do that?
Yes. So
which is the same question as how do we go from the world we're living in now to your world with more equity?
Okay. So let me speak to that. The first thing is really to retain equity because, there are earnings now and they keep wanting to pay them out. And that's exactly what they should be stopped from doing for a while because the easiest way to do this is not to go back to the equity markets, but to just retain what you've got. Okay. The other thing is to raise more equity. What you need to do is to basically do a rights offering, meaning, you basically offer more equity to your investors at a certain, potentially at a discount and raise the money from your current equity, or you go to the equity markets. Now, what might happen as a result, if you retain your earnings, or if you want to raise more, especially when you're already in sort of a debt overhang, your stock price might go down.
Right.
And that's one of the things they really hate. But the only reason for that, if we don't change anything else, we don't adjust the taxes and all that, and of course we are trying desperately to remove the implicit guarantees as well as we can, but this is a way we can do it. Right. You lose some subsidies.
You what?
You lose some subsidies.
From
having less equity to having more equity. Some of these safety net and tax benefits are lost. We're pulling away subsidies from an industry, basically, and they hate it. They kick and scream.
Yeah, but how do I? Who's going to buy my? No, but who's going to buy my?
At the price, anybody. In other words, it's the same end investors that own everything.
Sure, at a low enough price, people will hold it.
Sure, I mean, you have to offer it at the right price. We have to remember.
But isn't my equity going to go down potentially?
No, Look, in the bigger economy, this is nothing. I mean, the adjustments are minor. These are reshuffling pieces of paper because people are holding equities. Imagine that the bank, the question is what will the bank do with the extra equity? What will they do with it, right? So what will happen to their asset side? Well, one thing, they can lend. If they have good lending, they could lend, right? So they can complain that they can't lend with equity. That's the most ridiculous thing. Now, if they can't do that, let's imagine, start experimenting.
Well, I got to stop you there because this, I think, is the most central insight that I think everyday people and this economist sometimes struggle to understand.
Okay.
Again,
where is the equity going to come from?
No. It's simpler. They don't put the money in a box and bury it in the ground.
No. That's the thing. Is when you invest money in a house, it's in the house.
The only difference is where
whether
the source
you promised money
and how it's
right. The only difference is you're funding the same thing. You're doing the same thing on the asset side. You're doing the same thing. You can do the same thing.
You could.
You can do the same thing. I'm not restricting you. These are not liquidity requirements. They're not reserve requirements. I'm not restricting the asset side at all. I'm not touching what you do. You do what you find value in doing, supposedly. Right. Creating value, okay? What I'm only changing is the way you fund those investments. The way you fund those investments, instead of promising people, just have them join in as equity. That's all. That's all we're doing. It's the simplest thing to do. It just says, why only 5% of your investments funded with this way? Why not 25%?
And
it's a crazy situation.
Of course, it would change what you invested in because you'd have to convince people of the merits of it in a different way.
And then you'd make better investment. Yeah. The whole point we're making is that short of saying, quite the opposite of saying that this would restrict lending, it would make lending better. Not every loan is good. We saw subprime loans that were not good. So we want good lending. We just don't want any lending. So credit booms, are not necessarily good. So basically what we want is economically appropriate lending.
So, stepping back to my earlier point, the last, I don't know what it is, 20 years of bank regulation, which innovated, put that word in big quotes, the kinds of capital, that there were different ratios. What you're really saying is we need to create a much larger number as a minimum for how...
And a range, and a big range.
A big range.
There. That's a big range between, and in that range you kind of let it suffer some losses and you build up capital so you don't let them pay dividends when they are between, in my books, I don't know, we have lots of challenges in terms of how they implement it and all kinds of details there. I never get there because we're still at the level of, a lot of nonsense, but, say I'll dream up numbers, they'll say they're arbitrary, but let me tell you something, the Basel numbers are very arbitrary too.
Of course they are.
So they're completely political processes, not science. So say my numbers were between, 25 and 40% or 35%. In that range, you don't pay any dividends. And then you can go a little down, and when you build back your capital, then you're healthy and you can go about doing everything you do. What will happen to the size of banks? My point is they'll get to the natural size that's value driven. Okay. And that's how companies' size is determined. So I'm not regulating size. I'm first regulating ownership structure.
Yeah. So going back to the Lehman example, or any distressed bank, or making a transition from the current world to the world that you're suggesting, the other way, of course, is to sell assets. Correct? And hold the...
you could do that. And, if assets are now just trading assets that are just anybody could hold them, then there's no reason for these banks that are under the safety net to be the ones that own them.
Yeah, but I'm not sure what I said is right. So...
If you one way to satisfy, so say I have a fixed amount of assets, and I have a certain amount of equity, and I have debt. I could sell assets to pay down some debt and keep my equity.
That's what I could do, yeah.
And so that's one way. So in our paper, we have 3 ways to conform to capital requirements. Don't
pay the dividends.
One is no. I'm saying just statically. Statically first, you start with a particular balance sheet. You have 5% equity. One thing to do to have more equity as a fraction is to scale down. So that's what they say they would do. Supposing that all their assets are so valuable that they would have them, then they tell you that credit will go down. Yeah. The point, by the way, about that is banks are not the only ones who lend, and they don't have a monopoly on lending, and I don't mind that anybody else lends.
Well,
hedge funds lend, now peers-to-peers lend. There's all sorts of lending that's better funded than the banks. So they don't have a monopoly over lending. People who are not systemic can lend, and there's no restriction on lending.
But I think, as you said, somewhere something I read of yours, that's a feature, not a bug. I mean, there's too much lending.
Potentially, I don't know. But right now, there is not lending. Right now, I think we are in a credit crunch, but it's because they're highly leveraged already, and because they prefer to do other things, so the risk weights can distort it. Because what happens is when you have risk weights, for example, sovereign debt was 0 risk weight, AAA securities, 0 risk weight, as if they are risk list. Right. Well, we know that's not true. So when you measure the risk relative to risk-weighted assets, and certain assets get 0 risk weights or very small risk weights, then you are attracted to them because it allows you higher leverage.
Sure.
And so lending is sort of fully charged by, by their language. So nowadays in the U.S., what do you see? They don't want to make business loans. That's too much trouble. You have to monitor them. That's too much work for them. What they like to do, they go to municipalities. There's lower risk weight probably. That's the equivalent of going to sovereign debt.
Yeah.
They invest in hedge funds now. They woo hedge funds. I have lots of stories about that. Banks, because they have so much cheap money right now, they don't know what to do with it.
But they have, let's talk about that maybe, I don't know, we might not want to get into this, but, because it may be off the track, but it seems like it's not. The banks right now in the United States are holding very large excess reserves. They're doing nothing with it. They're not buying municipal bonds. They're not.
Well, they're trying to buy things that
they're buying some
yield stuff.
Yeah.
But
there's a lot of money going back to our question about sitting around. They literally have money sitting around.
They might, but right now, the banks in the U.S. have all kinds of lurking issues. They got a lot of problems with second mortgages that are not recognized. They got all kinds of issues. There are loans that are not performing that they're thinking that the Federal Housing Authority would cover, which, Deutsche Bank got into trouble about the same assets that the Federal Housing Authority said they will not cover because they don't qualify.
So you think some of the reserves are being held as a cushion against the disasters,
and also the foreclosure papers that they don't have, which are still lurking there. Yeah. So they have a lot of things, and they have some exposures in Europe and all kinds of things. Now, what are they doing with the assets? I mean, again, it depends on sort of the capital. I don't know. I am not an accountant, so I actually don't look. People who have looked at that, who I've talked to, think that there are some troubles there, and there are all kinds of investments you see them do that make you think what's going on. Those are trading assets that yield something and have relatively low risk weights, or why are they doing this or that?
So let's come back to your idea.
Plus, they expand globally, of course. Too.
Let's come back to your idea, which is which I like. One thing I like about it is it's simple.
Simple, yes.
It's simple.
The risk weights also complicated
complicated.
formula, and also they give them a lot of latitude to calculate things based on their own risk models, which is an invitation to manipulate the.
So for those of us who are worried that the financial system is a bunch of cronies who are manipulating the system to their advantage, what are the odds that a simple idea like this, which is politically, even though challenged by the crony problem, is dramatically easier, dramatically more credible to me than my preferred solution, which is stop bailing out creditors.
Right. I can talk to that in just a few minutes because I know about resolutions.
Go ahead.
Mm-hmm. Well, I mean, one of the things that Dodd-Frank did, and one of the things that really probably is a good idea in general, although you really don't want to rely on it, and that's what, Sheila Bair is saying, we're going to resolve, we're going to do this, that. FDIC is very good at resolving small banks. Resolving a city is going to be a mess. First of all, and deciding when to start doing that process is already challenging. How do you get your hands around a $2 trillion bank to know when they're right?
When you say a city, you mean a Citibank?
Citibank, yes.
Yeah.
Or any of these banks. In other words, just essentially doing a bankruptcy process to them that's somehow better than a bankruptcy process.
You're talking about
resolution authority.
Yeah, I interviewed Vincent Reinhardt, who made the observation that the only creditors that took a haircut in the mess, the only ones were, I think, it was either Wachovia or WAMU. I can't remember which one, but they went through FDIC, and they were the only ones. Everybody else got all their money, 100 cents on the dollar.
So all the hybrids and everybody was promised anything got it. So all the cushioning that was not equity was useless. So and so the whole notion of loss-absorbing debt, now you're talking about debt that, again, as you said, what's the upside? I mean, they get to lose, and they're not going to like it. There are legal problems with it, huge legal problems. If you have a global bank, legal systems are very different in different countries. Doing a resolution of a bank that has, 100 countries or 70 countries, and can move the money between countries. We're not at a place where we can do that.
And we tried this before. We had FDICIA, FDICIA, which was supposed to be a takeover by the government of the management of a bank that was in trouble, and it wasn't used because it was politically unattractive to enforce it.
The banks have grown so much and become so complex that it is we just have to really focus on prevention, basically. And it's very important to have to not have just bankruptcy as being the only sort of way to go. So resolution is really great, and I think the FDIC is the best agency around in terms of worrying about taxpayers, the best. And so it's good that they got to play here, but they're not really. Nobody is really in a position to be able to handle that very easily, in a systemic event, to have multiple failures potentially or distress. And, the banks saying, just give us assessments, we'll pay for our own resolution. That's exactly when you can't give them assessment because they are themselves probably bleeding anyway. That's when you give them TARP. That's when you start supporting their capital. It's not the time for them to start paying for each other's resolution. So all of these scenarios, you just really, they're very problematic scenarios, and all the resolutions take a lot of time. Meanwhile, the system is frozen, all of that. And so a government,
they're not going to use it.
All the read my lips, I won't bail you out, nobody believes.
Right.
So the problem is, that they probably will change the law and find a way or whatever.
So what kind of reaction have you gotten from your proposal, your idea?
I have to say, it depends where you're talking in this world. The best people on this, although they have their own politics, is in the UK. And the UK, and the best people in the space of the Western countries is Sweden, for example, somewhat Switzerland. But the UK has everybody focused on this. Now, they have bigger and dangerous banks, and Ireland is nearby, so they are scared.
Pressure,
But, for our banks to say, it's got to be a level playing field, let us be as big as them, or whatever, that's not a good thing. And in this country, who cares? Precisely as Sheila Bair said, it's not a national objective that our banks can go playing against some other banks. What's in it for me?
It makes no sense
to back them up when they, first they own their decision. Then I'm happy for them to go compete. If there's no safety net, then I'll cheer them on. But if it's a safety net, then I care that they don't go to 100 countries to play around and get the upside and leave us with the downside. So we care. So in this country, I'm very sorry to say, it's been more than a year, and virtually, now occasionally I would get to talk to a few people, but it was a wall that nobody wants to hear this.
No, because they like to play, and the current system
it was been
is
very,
good for them.
very frustrating getting through. Very, very frustrating. Even the newspapers, now the Wall Street Journal all of a sudden, is in favor of this, but they certainly did not take my op-eds for a while.
Well, there could be a lot of reasons for that. It's a hard
They
world.
don't give you any reasons.
No, I know they don't. You might not be because they don't like it.
Whatever. There was no. I stopped wasting time on that because I wasn't getting anywhere.
But you're saying they have.
There was no way to get through.
But they're more interested now than they were before.
There's a little more pressure, a little bit more in this country, a little bit more. To listen, but the truth of the matter is there's not been serious engagement in exploring, what we're saying and whether it makes sense or not. There hasn't been in the whole year of doing this.
Yeah,
I've been unhappy with the level of engagement that I've seen.
No, the problem is that I don't remember if I mentioned this on the program before, but somebody asked me the other day. Wondering why this was a prominent international bank person. Mm-hmm. He said, why is it that the banks remain so politically influential despite their lousy performance?
Precisely.
And I think the answer is the Willie Sutton answer is it's where the money is. So it's a little bit of a frightening Ponzi scheme where the government sends money to the financial sector. The financial sector gives it back to the politicians, and they're scratching each other's backs.
Yep.
And it's not a partisan issue, unfortunately. I wish it were. It's a bipartisan issue.
True. Across the board.
And what really disturbs me is that outside of our profession, I'll call our profession academic finance and economics, outside of our profession, most people are disgusted by it. We are, to some extent, not me and you, but academic economists have been the cheerleaders for justifying this last 2 years of subsidy, and the average person is disgusted by it, and yet the political power only moves in that one direction, and I don't know what we're going to do about it.
It's probably better that we got to the end and I don't get to talk about some of these things, because I've been also disappointed with some of the academics just not speaking up, and just because in some cases it's just you can be heard. If somebody wants to hear something and you give them what they want, then they'll want to hear you.
Oh, yeah. I think that's a huge part of the problem.
So
you want to be a player?
Exactly.
You want to be a player?
You don't want to argue and you don't want to fight, and it's not fun to be contradicting. And this industry has been way too involved after what they've done.
Yeah.
They're not the ones.
Well, you know what?
There are a few ex-bankers who are very honest.
Yes.
Look at John Reed. Look at Herb Allison. These people are going to say it as it is.
Because they're not on the
Precisely.
field.
Precisely.
Yeah, well, You know what actually sums it up? I've thought of versions of this before, but this moment really crystallizes it for me. It's called Dodd-Frank. What of all the people to champion the reform are the people who Dodd-Frank who helped create, to a large extent, a huge chunk of the problem. And the fact that they had not just a seat at the table with those bankers who should have had no seat, no voice, should have been shut out of Washington.
Exactly. Go away, we'll get back to you later.
You've misbehaved.
Right.
We gave you candy, and you now are going to have to go play by yourself for a while.
We'll tell you what the rules
are
later.
Yeah, we'll tell you when you can come back in the room. They're sitting at the same tables again.
They're testifying all the time. I was sitting right here, steaming at, J.P. Morgan executive going before the Congress, and here I am in California. I have more sensible and less conflicted things to say.
Yeah.
And he gets to go testify. How does that make any sense?
Yeah, well, it's the way the world works right now.
It's really very frustrating. So I don't know. Speaking is the thing to do.
Well, we try to spread the word with programs like these, but of course, my view is that anything that curtails the discretionary power of the Fed and the Treasury is a good thing. And although that's unlikely to happen for all the reasons we're talking about, there is more political momentum in that direction than ever before. And I think that's a good thing.
I just want to say one thing. I mean, there are a few things in Dodd-Frank that are sensible. Okay, I think in principle, the consumer safety is a good thing. I think.
Okay, I disagree with you, but that's okay.
But I think there's a lot of information. There's a lot of information that I've seen even some forms that are supposedly supposed to inform people and really confuse them about that. So there are things when Elizabeth Warren said there's more information about toasters than about financial contracts. I think that there was a point there, and there's consumer protection that you can do there. That as she's been trying to argue for a year, does not necessarily hurt bank, but they just instinctively fight anything. So who knows what's right there? I think Office of Financial Research, in principle, could give information because I think that
right, in theory, sure,
in theory,
more information's good usually.
Exactly, it's hard to fight against it. But again, I'm not that optimistic that it will do what it's supposed to be doing. Meanwhile, I agree with you that it in terms of what I'm talking about, what Dodd-Frank did is it created this FSOC. This FSOC, Financial Systemic Oversight Commission. So this was basically the group of all the regulators to monitor systemic risk and create capital requirements. The problem is, so in principle, the law did not say how much capital requirements should be. It delegated it to this group. So the only issue is, are they doing anything?
I guess it's going to get a lot of attention. I guess who's going to be doing the attending?
Exactly.
The banking industry.
So this particular group of regulators, if they're not going to do it, then it's useless to have delegated it to them.
Well, certainly agree with you there.
So that's where I am.
My guest today has been Anat Admati. Anat, thanks for being part of EconTalk.
You're welcome. Thank you very much for the opportunity.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.